What's up, everybody? Corey Smith here, CoreFX, bringing you another video here in the technical training room. Thank you guys all for being a part of the team. I just wanted to go over another video with you guys here. This is probably the most important video we will cover, and I want to make sure everybody goes over this video multiple times and not only studies it and learns it, but lives by it with every trade alert we send out, with every trade that they make, whether it's with our group or on your own. And really, throughout your trading, this should be the number one most important aspect of your trading plan, your trading style, everything. Risk management is really the make it or break it aspect of trading that is going to determine your success in this market. So first and foremost, we wanted to go over risk management, why it is important, and how we want you guys to go about using it, because we could have the best trade alerts imaginable sent to you guys, and if you're not using proper risk management, you could still be losing money and blowing accounts. Losses are inevitably a part of trading. Losing trades, losing days, losing weeks are a part of trading. That being said, when you have proper risk management and your wins are greater than your losses, then you, in the long term, are a successful and profitable trader. So what we want to do is ensure that you guys are using the proper practices to manage your risk and grow your portfolios while you're learning with us in the proper ways, instead of losing money and blowing accounts. So I'm going to go ahead and go over risk management here for you guys real quick so you have an understanding of what it is and how you're supposed to be using it. So first and foremost, the number one most important aspect of risk management is going to be our exposure. What this means is when we open a trade at any given time, we are putting capital in our portfolio at risk, right? So we are risking our hard-earned money every time we enter a trade, whether it's long or short. Because if we're long, the trade can go opposite direction against us, and if it's short, the trade can go upwards in the opposite direction against us, and ultimately make us lose money. So, what we want to make sure we are doing first and foremost is the amount of position that we enter a trade every single time is going to be the proper risk amount, right? So I have another video in here with the position tool calculator where I show you guys exactly how to calculate your lot size, right? So that's the actual share volume size that you are going to be executing on your broker platform. Right, our lot size. This is a 1.0 standard lot, a 0.10 mini lot, right? So, essentially what we want to be doing is making sure that we are risking the right amount of lots, but what it really all comes down to is what percentage of risk of our portfolio we are risking per trade. Right? So our position size, our lot size, we determine to know the amount of risk on the given instrument we're trading that we want to be risking. But the percentage risk of our account is the foundation number that we are going to be focusing on, that we need to determine prior to going to our position size calculator. So when you see our position size calculator video, you will see that it shows a few different inputs you need to put into the tool to calculate exactly what your position size is going to be. This is going to be, the currency you're trading in, the exact pair you're trading, the amount of pips you have a stop loss of, the size of your account, and then most importantly, the percentage of risk per trade you are going to be risking on that one given trade, right? So 1 to 5% of your total capital is the threshold you want to be in. I mean, you could do less than 1%. You can do half of a percentage per trade. There's nothing wrong with that. That's just maintaining your capital more. You're not going to be, going out to win as much. Your profits are going to be minimized, but your losses are also going to be minimized. So that's fine as well. I like doing that, especially when I'm testing trades out or when I'm legging into a position, or maybe I am testing news trades or trading a strong volatile event. However, the typical period and size to be in is 1 to 5. Really, I would say 1 to 3%. So what does this mean? Just to pull this out for you guys to visualize it. If we have a $10,000 account, right? We're trading a $10,000 account. For every one trade we take, we want to risk 2%, we'll say. It's in that 1 to 5% threshold. I would recommend 2-3%, right? So $10,000 account times 0.02 to get us our 2% risk, right? That's 2% of the account, is $200. What that's saying is we are risking $200 for every trade that we open with a $10,000 account, right? So with our stop loss in place, which is another concept we will go over, with our stop loss in place, once we execute a trade, whether it's your own trade that you determine with your own plan, whether you're trading alongside one of us professionals here at CoreFX, whatever it may be, you're risking $200 for one trade with a $10,000 account, right? Now, typically, what we want to go for is a 2-to-1 risk to reward. So double our risk would mean we're trying to make $400 on that trade. So we're risking $200 to try to make $400 on a trade with a $10,000 account and 2% risk. Okay, so this risk management philosophy and idea is what you need to implement for every trade you ever take, no matter what. No matter what. If you're jumping into a trade and you don't have the time to do position size calculator, determine your risk and all that, don't take the trade. You're only going to end up hurting yourself. I can promise you that. So number one, most important, determine your risk percentage per trade that you're going to be allocating from your capital, right? So if you're risking 1, 2, 3%, I wouldn't go above that until you're consistently profitable for a while, and then you want to just increase your profits. And above 5% is even something I would never recommend, but I've seen professionals do it. Anything above that, your normal drawdown, your normal losses that you can sustain as being a trader can be too great with that high of a risk on your portfolio. So 2 to 3%, I would say, to stay in the sweet spot. There's no reason to go above 1 or 2, though, while you're learning and while you're new to this, especially when you're trading somebody else's trades like you're doing here. You want to be learning from us and hopefully making money alongside us by using these proper risk management methods, right? But don't ever take a trade without following this. Then you want to have a set exposure amount for trades open at a time, right? So that's another thing. You could be in our group and you could see Sivan and myself sharing, 5 trades in one day. And this could be, maybe Sivan's risk management is 1% per trade, 3% total max at any time, and he's in 3 open trades at a time, right? So 1% risk per trade trades is 3% exposure. He can be in 3 trades. Maybe mine is 5%, or let's say a 3% max risk at a time as well, and I have 1.5% per trade. I'm in 2 trades. That takes 5 trades total. But if you are watching our signals and you see 5 trade alerts come out, if you enter all 5 of those trade alerts with a 2%, 3%, whatever it is, normal risk management rule, you're going to be overexposed. You're going to have 10+% of your portfolio at risk at one time. You do not want that, right? So another thing you need to predetermine in your risk management is your set amount of trades open at a time. And if you're risking 1, 2, 3%, I wouldn't have more than 2 trades open at a time, maybe 3 max. But one thing you can be a little bit flexible with in there is, let's say you're in a trade for a couple days now, and you're in profit and you're taking your stop loss to break even, or maybe you've taken some profits off the table and you're trailing now, and basically that trade has no more risk on the table. No matter what, there's no way that trade is going to go against you to become a loss. So you can wipe that off your board of open trades. You don't have any risk on the table. You don't have to consider that an open trade. So let's say you have that open, then you can open 2 more trades and you only have 2 trades open exposing you. So exposure to your capital is huge when it comes to risk management. And then set amount of pending orders placed at a time. If you trade a lot of breakouts or pullbacks or range-bound moves and you place pending orders and you wait for price to pass your pending order, then you're activated, you might want to have a limit of pending orders placed at a time, because if something happens and you're not near your computer, or you didn't realize it, or you're sleeping, or whatever it may be, and you have a bunch of pending orders triggered at once, you could destroy your account. You could absolutely destroy your account without paying attention. So we want to really, really focus on these things here, guys. We want to really, really make sure our trading plan, even if you are new to trading and you're just following alongside us, taking the trades that we trade, and you haven't started developing your own trading strategy or plan or anything yet, this is something you need written down and to follow day in and day out with every trade you ever take, or I promise you, the 1,152 pips we just made last week, that is a stellar, unbelievable amount of pips, could have been devastating for somebody that used the wrong risk management, because if they caught 1 or 2 of the smaller losses but risked too much of their capital, they could have blown everything and missed out on tons and tons and tons of profits because they didn't manage their risk properly. So this is something that we very, 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 very strongly recommend everybody, we demand everybody takes into consideration and implements into their plan as being a part of this team, because it is only going to lead to your success. Okay? So another thing that we want to focus on is our drawdown. This is our mercy rule. This is our tap out. This is our give up sign. This is when we've had enough is enough and we need to take a step back from the markets, recoup, get our thoughts together, get everything gathered, and figure out what we're doing next. This is going to be broken down on a daily, weekly, monthly basis. And another thing that you guys need to ensure you follow, right? So how many losses can you take in a day until you stop trading? So if you're risking 2% of your account and you lose 3 trades in a day, that's 6% of your account in one day that you just lost. That is certainly, in my mind, a time to take a step back, reevaluate everything. The markets are just not cooperating with you that day, or maybe you're just not there mentally, or maybe your setup's just not playing out, or whatever the reasoning may be. There's no reason for you to keep everything about your human psychology is going to want you to stay in and keep trading because it's revenge trading, right? Your body just felt pain from the losses, and the first thing your body wants to do whenever it feels pain from things like that is remove that feeling. And the quickest and easiest way in trading to remove that feeling is to make another trade and try to win the money back. Now, that is going to be devastating if you let your body do that. So we need mercy rules. We need drawdown in our plan telling us, okay, if I'm taking Savant and Corey signals this week and I take 2 of them today and they both losers, I'm done for the day. I don't want to trade anything else until tomorrow. It's a new day. Or maybe I want to wait till next week, whatever it may be. And then you have the same rules and limitations, obviously at a different extent, for weeks and months. So if you have a 2 trade per day loss, stop out, drawdown, mercy rule, whatever you want to call it, then maybe for the week you have 5 trades, right? So if you have 5 losing trades in the week, maybe you stop for the week. Or maybe if you have 2 consecutive losing days in a row, you stop for the week. Maybe in a month, if you have, these rules aren't only on losses, but what I recommend is on percentage of capital lost, right? I'm saying losses just because everybody's going to have different capital amounts in their accounts and everything like that. So let's say daily drawdown 5% of your account, you stop for the day. Weekly drawdown 10% of your account. If you lose 10% of your account in a week, you stop for the week. And then monthly drawdown 20-25% of your account. If you go down that, you stop for the month. Those are strong rules that I would suggest everybody follows. If you lose 20% of your account in a day, that's just beyond absurd. That's just terrible risk management. You would have had to have lost 10 trades straight, risking 2% per trade without a single winner in between, which could happen, but very, very rarely. And I wouldn't recommend making 10 straight trades in a row in that short of a time period. But that's why we need to have discipline. We need to have rules. We need to follow them, and we need to manage our risk. And drawdown is an extremely, extremely important risk management tool that not many people use. And then what are your rules for the next actions you take if you hit your weekly, daily, monthly drawdown limits, right? So if you get stopped out for the day, are you just going to, just go cry in the corner for the rest of the day and wait till the next day? Or are you going to have a plan of action to try to better yourself as a trader and as a human being? Are you going to, go and find a book to read? Are you going to have a book that you have on demand ready for, when you get that drawdown and you have to step away from the markets, you can go and educate yourself? Do you have a journal that you can go and study and see and investigate into your trades and find out exactly what went wrong on those trades and why they didn't work out and what you could have done better to make them work out in the next time you do it? There's a number of different things you can be doing. Do you want to, have a demo account on the side so that as soon as you stop trading your main account, maybe you switch to demo and start practicing different ideas and different things on there? Obviously, the psychology is totally different with demo than live, but there are still a lot of beneficial things. Are you going to backtest? Maybe after you get stopped out for your drawdown and you're done for the week, you can help yourself out by going and backtesting your strategy on historical charts. You can go back in time and play out candle by candle your strategy and see how it performs, right? So there's a number of different things that you should be doing and could be doing once your drawdown is hit. Just make sure you have a plan of action. Any success in life comes with having goals and setting actions to reach those goals. And trading is probably one of the hardest professions in the world. So if you think you're going to get there without doing these things, you're really going to have to reevaluate the situation. And drawdown and risk management are two of the biggest components of having goals, being smart, being prepared, taking action, and working towards achieving them. So other than that, really quickly, we have trade management. Basically, this is managing our trades, while we're in them. So obviously, we want to have predetermined stop loss and targets. I go over this in the order placement video. But this is essential. Going into a trade, this is why we send out alerts with predetermined stop losses and take profits. Now, we adjust these as the trade works in our favor, but if the trade goes against us, we never adjust our stop loss, right? So we have predetermined stop losses, and our managing our trade, which is also another aspect of risk management, is once we're in a live trade, when and how will you adjust to break even? If you even do adjust to break even, when will you take profits off the table? When will you adjust your stop loss up into profit, up to break even? When you get out of the trade, essentially, is what this means. And this is another very crucial part of trading. We will be updating you guys with trade management. We'll be telling you guys when we will be adjusting our stop to break even, when we will be taking our first profits, our second profits, and so on. But we really highly recommend you guys start developing your own ways of doing this. In the CoreFX training course that I have, I teach you guys all the ways to develop your own. I show you guys all the correct ways to doing it, how to determine them and all that. But we really want you guys to start focusing on yourselves and being independent and developing your own management for your trades, because this is extremely important. Watch how we do it, learn how we do it, and just make sure you are actually doing it, and you guys can find that common ground of knowing precisely every time you trade exactly when you're going to take your profits, exactly when you're going to adjust your stop loss, exactly when you're going to trail your stops. These are things that you must know going into a trade, because once you're into a trade, there are too many emotions on the table, and you're not going to see clearly or make right decisions, right? So if you're in a winning trade and you have a predetermined stop loss, then you can use your discipline to make yourself wait till that is achieved. Otherwise, you're going to go in blind, and then you're just going to do whatever your emotions are telling you to do once you're live in the trade, because before we take the trade, our emotions aren't there. But once we're live in the trade and our money's on the table, that's when our emotions come out. And we want to make sure that we clear out our emotions as much as possible and have a clear mind when we set our stops and targets to begin with, and then we follow our plan strictly once the trade is open. All right, guys. So that should cover you guys all for trade management and risk management here. This is a very crucial part of success in trading, and if you want to be able to make money trading alongside of us here at CoreFX, you need to enforce risk management, because as soon as we have losing trades, things of that nature, this is when people are going to start panicking if they're not managing their risk properly, right? So if we have a few losing trades, that should be a couple percentage of our account here and there. When we have months like we've had in the past, where we have huge pip gains, that should make us so much money and so much percentage gain in our capital that the few losing trades here and there along the way do not do anything to us. That is why we want to manage our risk consistently with every trade, so that we have consistency with our results, right? So I hope you guys enjoy this video and really focus on taking what I'm saying seriously, enforcing it into your trading plan, and making sure you follow it. Make sure you check out the position size calculator video, because that is going to show you exactly how to properly determine your position size to match your risk percentage per trade, right? So you have to put these videos all together and ensure that you are acting properly in risk management, in taking these trades, in learning how to trade, and then that will help ensure that the profits follow. All right, guys, thank you very much. I appreciate it. I hope you enjoyed this risk management video, and I'll catch you in the next one.